if someone asks me, is the thesis for Bitcoin or Ethereum broken? It's absolutely not, because one, the more work we do, and we're hearing it from founders like Palantir, Bitcoin and Ethereum are really the future of money, because mass and compute, or compute and energy, however Elon puts it, really are what's scarce, and you're going to need to control agent system. I think that is going to set up for after 2026, perhaps, over the next 2 years, some of the biggest gains of the stock market in our lifetime.
Mark Cuban may have dumped his Bitcoin, calling gold the better bet, but Tom Lee says investors are missing the bigger picture. While crypto has disappointed and many are rage-quitting the market, Lee argues that Bitcoin and Ethereum's core thesis remains stronger than ever. As AI transforms the global economy and Wall Street moves toward tokenization, he believes digital assets are becoming the future of money. Could today's frustration be setting up tomorrow's biggest opportunity?
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
Mark Cuban, I don't know if you saw, Mark Cuban said that he's now dumped or sold all of his Bitcoin, given that he no longer believes it's acting as a hedge against inflation or anything else. Argues gold has proven to be a better bet, and that Bitcoin has not acted the way it should if it's supposed to be digital gold. What say you?
Well, on the one hand, I think Mark is right. Crypto's been disappointing, because crypto should move with, equity markets, and it should be rallying with software. Software has really started to rally big, and crypto hasn't moved. So I think there are what I call, quote, rage quitting, people selling here as if something is wrong. I mean, one, I think that's what always happens at the end of crypto winter. If someone asks me, is the thesis for Bitcoin or Ethereum broken? It's absolutely not, because one, the more work we do, and we're hearing it from founders like Palantir, Bitcoin and Ethereum are really the future of money, because mass and compute, or compute and energy, however Elon puts it, really are what's scarce, and you're going to need to control agent systems. And as AI systems evolve, right, we're now talking about using commerce and operating websites. You need decentralized identity and verification. That's really what crypto does. And we know Wall Street wants to go towards tokenization. It's a vast improvement in efficiency of actually how money moves, and it's an innovation. Well, that only happens on Bitcoin and Ethereum and other smart contracts. So the future isn't changed, but the spotlight today is, of course, on semis, memory, starting on software. But as people focus downstream into the future, that's really, I think, when the bid comes for Bitcoin and Ethereum.
Because when you talk about stocks, it was so easy for you. You did it. $10 times 4, that's $40. Put a multiple on it, that's 800 points. Why do you even try with Bitcoin or Ethereum? What's your comparable analysis to be able to come up with anything to make predictions about Bitcoin or Ethereum? There's nothing that you can base it on, Tom, except maybe psychology or sentiment or something.
Yeah, actually, market sentiment plays a huge role, because it's sort of essentially risk premia. But there are two proven ways to value crypto. One, of course, is just network usage, because wallets and activity per wallet still explain, like, even now, 87% of the rise of Bitcoin. So as long as more people use it and they're transacting it, the value of Bitcoin should go up. It's a network effect. And the second is the umbrella value of gold. Gold when it hits 5,000, if Bitcoin had the same network value as gold, and gold is not as scarce as Bitcoin, that would put Bitcoin at around 2 million. So to me, I think there's still two ways to look at the value. And of course, for Ethereum, it's been shown for every dollar of tokenized assets, tokenized dollars or others, it's created $1 value for ETH, the coin. So if you believe Wall Street's going to tokenize, Ethereum's price should go up a lot.
In the past, you've made some calls that people should never make. Like, it's going to be a good inflation number on Friday. S&P is going to be up, 8% this week. And a lot of times it was borne out. And you've got a reputation for being fearless that way. The most recent thing that you did, which came through, and it doesn't really show it that great on that chart right there, but for the year you were bullish, and we were going along quite nicely till the war, and I remember it was almost a mini Liberation Day sell-off, not quite as bad, but pretty steep, and you said it's already done, and by the end of this month, we're going to be significantly higher. And it was right in the midst of things hitting the fan. Not only did that happen, we took off in April, just like you said, and we've continued in May. So, I mean, you could take a complete victory lap. And we've got so many people that come on here that have no idea what the market's going to do near term or long term. And it just contrasting, you know, what you do so well from time to time. You can't do it forever, though, Tom. You're going to be wrong one of these days. But you're right again this time.
Yeah, well, yeah, thank you, Joe. I know it's been a tough market for folks. I mean, I'm not surprised. You know, we were kind of expecting 2026 to be a year where turbulence could happen and people would see head fakes. But there's still some really powerful tailwinds for America. You know, one is, of course, the AI story. And now we're learning about the energy independence, right? America can deal with high oil because we're not going to have a shortage of it. And then there's further tailwinds coming because as AI moves downstream, it's really benefiting American businesses. I think that's why S&P earnings came in for just the first quarter $10 higher. That's $40 for the year. And if you just put a 20 multiple, that adds 800 points to the S&P. So I think there's a lot of grounding for why stocks are able to recover. So it's, but you know, again, I think we still might have challenges between now and December. So I think everyone still needs to be vigilant, but generally bullish.
What did you say about the next 2 or 2.5 years being some of the best market activity that we've ever seen? You still feel that way? And that was not on this show. You said it somewhere else. But what is your forecast for the next 2 years, and what's it based on?
Well, I think a couple things are coming together, Joe, that are going to really support a few things that may only happen like once in our lifetime. One is I think the U.S. economic growth rate is actually starting to step up. You know, in other words, we could grow at 4%, and for a mature, largest economy in the world to start to accelerate growth, that's pretty astounding. The second is the U.S. is one of the biggest exporters of the most important tool in the next 10, 15 years, which is AI products. And that means we are a net, essentially, exporter of a high-value product. And there's so much capital, I think, misallocated today because so much of it is held in private alternatives, but it's going to move into the public market. So I do think that, plus the demographic tailwind of millennials and Gen Z adding to the workforce, but then also beginning to inherit generational wealth, I think that is going to set up for after 2026, perhaps, over the next 2 years, some of the biggest gains of the stock market in our lifetime.
We just had a board. So you think, we hit 7,700 near term, and then there's a pullback, and then after the midterms, is it coincident with the midterms, the pullback, and then we had higher afterwards? Was that correct?
Yeah, I think that's. I mean, this is our best guess. I think June markets can still build on the gains, just not at the rate that May did, and I think it is money moving downstream. So there's going to be software rallying and beneficiaries of AI. But between, let's say, June and October, we do have to digest potentially 3 major IPOs coming, and the market will try to understand Kevin Warsh's new sort of model for inflation, but I think the market always tests the new Fed. And then we have that normal seasonality around midterms. And so I think we could have a drawdown that'll feel like a bear market. And as you know, that February to April was just a 9% decline, but it felt like a crash. And so I think markets are going to really struggle if we start to have a drawdown. And then, of course, from October, I think that's when a very strong rally start.
One of the biggest criticisms of cryptocurrencies is that they are difficult to value. Unlike stocks, Bitcoin doesn't produce earnings. There are no cash flows, dividends, or traditional valuation metrics. Tom Lee acknowledges this challenge, but argues there are still proven frameworks investors can use. The first is network activity. Historically, the growth of wallets, users, and transaction activity has explained a large percentage of Bitcoin's long-term price appreciation. The logic is similar to other network-based businesses. As more participants join and use the network, the value of that network increases. This is the same principle that helped drive the success of companies like social media platforms and communication networks. The second valuation method involves comparing Bitcoin to gold. Lee points out that gold remains one of the world's largest stores of value despite not being as scarce as Bitcoin. If Bitcoin were eventually to achieve a network value comparable to gold, its price could rise dramatically from current levels. His broader point is that Bitcoin doesn't need to replace traditional currencies to appreciate significantly. It simply needs to continue gaining acceptance as a store of value and digital asset. For Ethereum, Lee highlights another important trend: tokenization. As Wall Street increasingly moves toward tokenized assets, blockchain-based settlement systems become more valuable. If trillions of dollars of assets eventually migrate onto blockchain networks, Ethereum could become a major beneficiary because much of that infrastructure is built on its ecosystem.
Over the weekend, it did look like there was progress made with regard to Iran. It's evident in oil prices and yields, both of which declined from pretty high levels. Now, that being said, we do have to keep in mind that even as the front end of oil prices come down, there are still higher gasoline and diesel prices ahead. And in fact, around the world, there's going to be potential shortages of petroleum products later in the year. So it is something to be mindful of as we move through the year. As for macro, there is a lot of data coming this week, mostly Tuesday and Thursday. On Thursday, we're going to be getting, number one, the macro update webinar, but also April core PCE. And we'll have some more commentary as we get closer to that date. There's also a lot of Fed speak this week, but Kevin Warsh is not speaking. But I think one of the things that we've been fielding is questions from investors about why the U.S. is outperforming now. And I think it really comes down to this tweet by Elon Musk, where he points out that in the future, it's not really dollars that are the key currency. It's going to be mass and energy. And I think it's his way of saying that basically all that matters today is compute and energy. And if we look at that, it might explain why the U.S. is leading. For instance, if we do a breakdown of comparative advantage, the U.S. has an advantage in population growth of prime age workers. Regionally speaking, it's just the U.S. and Latin America. And if we look at compute, there's only 3 regions that really have a lead here. It's US, China, and Korea. And then when we factor in energy independence, or basically the ability to have surplus energy, it's really the US, because we're a net exporter. And China is a net importer. Korea and Europe are net importers. So basically, when you look at who's got an advantage across all 3 really important vectors, it's the US. And maybe second is South Korea, because they're an important AI hardware partner here. As you can see, Korea for most of the past decade has been underperforming the rest of the world, but has recently started to outperform. In fact, if we look at these 3 regions lined up, US, China, and Korea, you can see this underperformance of Korea was kind of mirroring China, but only in the past year has Korea broken out.
I mean, Tom, you see the activity in the microns and the snowflakes, and you think what as you watch this market?
Well, I think it was a great conversation with Liz, but one thing to keep in mind is now that Q1 earnings is behind us, people thought S&P earnings would be $70. It's going to come in at $80. So that's a $10 beat. That's $40 annualized. That means that the upside to earnings is somewhere between 800 and 1,000 points of S&P upside. I think the entire rally since April could be explained by just the Q1 earnings beat.
You're calling for a three-phase market still. Explain to our viewers again what that means.
Yes, our base case for this year, which we expect it to be a challenging year, and it feels like it, is we'd rally towards 7,300 initially. Now we're above that. But I think
we're almost 76.
Yeah, and I think we can get to maybe 77, as high as 77. But I think then we're going to digest a lot of things until October, and that's a new Fed chair. It's the energy shock that Liz talked about, especially shortages of petroleum products and lubricants. AutoNation talked about it. And the third is the IPOs of SpaceX, OpenAI, and Anthropic, that when the unlocks happen, that's a lot of extra supply. So I think that could pressure stocks in a way that feels like a bear market. But then post-midterms, I think we rally strongly, and 2027 is a year where we might see some of the best returns we've ever seen in our lifetime.
All right, Brian. So you had the benefit of listening to Liz Ann and now Tom's answer. How does it match up with what you're thinking?
It doesn't differ that much, because when we came out with our year ahead piece for 2026, we explained to investors that the market environment in 2026, Scott, was going to be very different than the last 2 years or 3 years of the bull, meaning it was going to be an earnings-driven market. Earnings-driven markets are much more volatile than momentum-driven markets, what Tom's done an amazing job talking about. But they also reward in both directions. If, like Liz says, and what I think is ultimately going to happen, is that you start to see a diminishing and deceleration of the large cap stock EPS. You're going to have some fear, Scott, and people are going to act on that. That's kind of number one. Number two, it also says that you have more corrections during an earnings-driven market, and we've been saying that we're going to have some sort of a correction. I don't think it's going to be quite a bear market, but to the tune of 5 to 10% heading into the fall. And then we finally have our broadening out theme. I still am a big believer in the broadening out theme, and I think that's what's going to really drive things into 2027.
Why would we have a correction? You mean like earnings are not going to live up to the moment, and that's going to cause the correction? So there's got to be a mechanism, theoretically.
So if you think about how great the earnings have been, and Liz nailed it when she said, if there's any kind of blush of any kind of change in tone for management, if they go from a 30% gain in earnings down to 20%, that's a big delta, even though 20% is an amazing earnings gain, but that's going to scare people enough to sell. The other thing, too, is that what was lost in what she said was very, very important. When you run money in portfolios, you can either let your portfolio drift with the market, or you set your back to your original weights. I think it's going to be very, very important over the next 4 to 6 weeks to set back to the original weight, especially considering how far stocks have gone. You've got some stocks that have doubled and now are bigger in weight than some of the Mag 7s in your portfolio, and that's a problem.
You feel like when you look at a snowflake go up 40% in a day, or the microns, these moves, as I've described them, used to be special. You'd see this once, who knows, a few years for a name. Now they're becoming routine.
And that's a problem. That's a problem because now we're becoming used to it. And anytime in the market you get used to it, you get lazy, and that's where we could see that correction beginning to reverse, and that could really spew more downside.
What's going to push money towards the other parts of the market? Does it have to be the end of the war? Oil has to come down? Yields have to come down even further? Do we need, a signal from a Warsh-led Fed in mid-June that, well, the market may be pricing in a hike, we could actually cut rates?
I mean, if I took a step back, oil has moved in a way, and it's created inflation in a pipeline in a way that financial conditions have to tighten later this year. So I think the bond market is pricing in a hike now instead of easing. And I think as long as that's what the bond market's pricing, it is tougher for a lot of groups to rally, because most groups need a dovish Fed.
Yeah, no, but if some people say, well, the bond market leads the Fed, with a new chair with a decidedly different view on not only the mechanics of inflation, but the dealing with, how he wants to put his own stamp on this, that maybe this is the Fed that's going to lead the market. Like, maybe the market's wrong.
Yeah, I mean,
can you see a Kevin Warsh-led Fed with he as chair hiking rates anytime in the near future?
I think Kevin Warsh has a very difficult task, because the bond market already has its template. He wants to cut rates but shrink the balance sheet, so there's a lot of sterilization taking place there. It's almost as if someone takes over the role as CEO of a company and says, we've got a new way of telling our story. Investors will be skeptical at first, and I think that's why the market will test this Fed.
The most striking prediction from Tom Lee concerns the period after this potential correction. He believes that once markets move through this adjustment phase, conditions could be set for an extraordinary rally. His reasoning is based on several factors. AI-driven productivity gains should become increasingly visible. Corporate earnings could continue growing faster than many analysts currently expect. Demographic tailwinds should continue strengthening. And America's competitive advantages in technology, energy, and innovation could attract substantial global investment. When viewed together, Lee sees the possibility of a market environment unlike anything investors have experienced in decades. He stops short of guaranteeing outcomes, but his framework suggests that the years following 2026 could produce returns that rank among the strongest of modern investing history.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.